Ladies and gentlemen, welcome to today's IMFS Policy Webinar. We're delighted to have Harald Uhlig here. I'm I'll wait a few seconds more because online I can see that people are slowly coming in. The numbers are going or quickly coming in, but it always takes a minute until everyone is in. So we're getting close to that. My name is Volker Wieland, Managing Director of the Institute for Multi and Financial Stability. We're happy to host this series. As I said, today, we're very pleased to have Harald Uhlig here again. And I'm also delighted that he's actually physically visiting the IMFS here in Frankfurt. So you see him already in video. He has the beautiful background there of the city of Chicago, the scene from the lake. And but he's actually physically here in Frankfurt and visiting the IMFS for a while. And we had great discussions, and it's really good. I think you're the first physical visitor for a long time, Harald. It's really good to be back to more normal academic discussions, even though there's still few people in the building. So thank you for joining us. But nevertheless, we thought this is also, of course, a great way to reach out to an international audience. And so we're delighted to have so many of you participating. As you've seen from the invitation, the topic is very current, very topical policy topic: digital currencies. What does the future hold? And there are, of course, private digital currencies here. We've been talking about Libra and Diem and central bank digital currencies. And Harald has already written a number of deep research papers on this. Today's talk is a little bit for a broader audience, but he will, of course, draw on this. And roughly, we have allotted about half an hour for the presentation. There will be slides. The slides will be posted on our website later, so you can download them if you're interested. And after that, there will be time for questions. You can actually write your questions in the Q&A tool during the talk, and you can vote on questions, as many of you know. And so then we have lots of time to answer these questions. And also we've seen there are many of our well-known academic friends from around the world participating. And so if you have questions where you want to go deeper technically, of course, they can be raised and Harald can address them later, but we're reaching out to a broad audience. So thank you, Harald, over to you.
Yeah, thank you so much, Volker. Thank you so much for the opportunity to visit here, for your hospitality. It's really wonderful to be in Frankfurt and to talk to you and to talk to the colleagues here. And it's really, such a pleasant change compared to what has been going on for the last 1.5 years. So I could talk a lot more about that, but let me talk instead about the topic that was announced, and let me share some slides for that. So here they are. And that's the title of the talk: Digital Currencies, What Does the Future Hold? Now, I have to admit that I was guilty of suggesting that title. And in retrospect, I realize that's a dangerous title to propose, right? Because what do I know about the future, right? I mean, we think of economists as having some kind of crystal ball that they look at, and then the crystal ball will reveal the answers about the future, and you can discern what's going on in the future. And of course, I don't, right? I can make guesses, but predictions are always hard to make, and particularly about the future, as a wise person once said. So nonetheless, let me try to look into this crystal ball here and see how far we can go. And the talk, the plan for the talk is the following. I want to give a general talk about digital currencies that includes both the private cryptocurrencies and recent developments on central bank digital currencies. But I will, toss in, the various papers that I've written on that topic over the last 2 years or so, and here they are, right? So, I'm giving you a taste of my research. Each one of these papers would be easily in our seminar on their own. So obviously, I can only scratch the surface. Indeed, I can only scratch the surface on this entire topic in a limited time. So I'm going to show you the battlefield, what's going on. And then I'm going to turn first to the private cryptocurrencies. I'm going to talk about Bitcoin and the blockchains. And you know, that obviously is a good starting point for any of this. And in that context, I'm going to talk about 2 papers of mine with Shilling. And then I'm going to talk about the cryptocurrency marketplace, big players. There's a paper of Benigno, Shilling, Uhlig, and another paper on Uhlig C that I'm going to talk about in that context. And then finally, I'm going to turn to central bank digital currencies, about the pros and cons. And there's going to be 2 more papers on that. And then finally, I'll summarize, maybe looking at the crystal ball and it's saying where things will go. Okay, so this is this is where we are at. I think the world of payment systems and the world of currencies is undergoing a dramatic change. Now and in the next couple of years, and we really have to see how this all shakes out. I mean, it's fascinating to watch, that's for sure. And I think it's going to be larger, and things will be upended here and there. There will be winners and losers for sure. So first of all, we now have a very active market for privately issued cryptocurrencies. The big one there is Bitcoin, of course, that exists since 2008. With Bitcoin, we got a new technology, and that's called the blockchain. The blockchain has applications far beyond cryptocurrencies, but even within the cryptocurrency world, there are applications that go far beyond traditional cash. And I want to talk about that a little bit. Today, we have several thousand cryptocurrencies. I'm going to show you the marketplace there. And we also now see attempted, I should say, entry by big players. Facebook for now. They're not fully through, but I think once Facebook is there, I wouldn't be surprised if you see more. So central banks have now also begun talking about introducing their own digital currencies, and these will be the central bank digital currencies. And why are they doing that? I mean, they're doing that because that's a wave of the future, you could say. But you also sense that this is a response to the competition of private cryptocurrencies. I mean, they just have to get with it. Otherwise, they're going to be swept to the side, and then they might lose control of the monetary system. All of that, of course, is competing against traditional means of payments, cash, foremost, of course. People also use deposit accounts and credit cards for payments. PayPal is interesting because in some ways, it may serve some of the functions that cryptocurrencies will serve in the future, although cryptocurrencies offer more possibilities. And in response to that, central banks have now introduced these fast retail payment systems. It's already alive in Europe since 2017, will come alive as Fed now in the United States in 2023. And we have to see how that shakes out relative to these central bank digital currencies. One of the key issues, and I want to touch on that just a little bit, but maybe you can think about it while I talk, is this whole issue of privacy versus criminal activity. People don't like the government, looking at all the spending that they do, even if these are entirely legitimate transactions. So, giving central banks, insight into, putting the whole transactions, out to the central bank may be uncomfortable for some. But then, of course, maybe that's precisely what you want to do, because there are also criminal activities where if you could only see the money trail, you could probably combat the crimes better. We know that in the official financial sector, we have all these developments towards KYC, or know your customer. And people that don't like that, they're probably attracted to these privately issued cryptocurrencies, and you have to be aware of that and being overzealous in imposing lack of privacy in the official currencies. All right, so let me talk about Bitcoins and blockchains here. Bitcoin was introduced by a white paper by Satoshi Nakamoto, Bitcoin, a peer-to-peer electronic cash system, in 2008. Nobody knows who Satoshi Nakamoto is. You can actually look at the Bitcoin blockchain. You can see that he has now, I believe, 68 Bitcoin. He's never spent any. But, who knows who he is? Maybe it's a she, maybe it's a CIA, maybe it's a consortium. We really don't know. And here's a simple image of the blockchain. And talking about even this simple version of this would take much longer. So let me take you super briefly through it, how this works, right? I mean, you're probably familiar with that. If not, this may be a quick introduction. Let's say Alice wants to make a Bitcoin payment to Bob of, let's say, half a Bitcoin. She will then, tell the entire world about this transaction. Now, presumably, you don't want to do this with your names attached, the account numbers attached, but you can already right there see that in principle there are issues of secrecy if you think them through. But let me not dwell on that too much. I mean, if you hide behind the account, then maybe that's reasonably secret. Then all these transactions are collected with other transactions that are out there. And then finally, you need somebody that brings these transactions on the chain of pre-existing transactions. So there's a chain of pre-existing transactions, and transaction for computer are just digital numbers. So let's just say this entire chain can be summarized by presumably a very long digital number. Here, just to have a hexadecimal short number to represent this. And so somebody needs to add these transactions to that already chain, to the original blockchain. And this is what these miners do. So there are many, many miners out there. What does a miner do? The miner adds another transaction where he or she awards himself 6.25 Bitcoin. And that's a number now. That block is a number. And then finally, the miner essentially has to guess, right? So the miner is just making guesses. And if he makes a good guess, then a function that he can calculate will tell him that some threshold is reached, and you can add this to the existing blockchain. This happens about every 10 minutes. And if you calculate how much Bitcoins are awarded in terms of money, that's somewhere between $3.5 and $4 million a day. So that's quite a bit of money. Now, what's interesting about this here is that this is a new technology, and you can do a lot more with that. And I think that's really one of the opportunities that we haven't fully explored yet, even for Bitcoin. And that's something that central bank digital currency, I think, should be thinking about. And that's a possibility of smart contracts, things like non-fungible token. All what this all means is you could have several parties to this transaction, and you could make these transactions contingent on other events. You can stick other information in there, so you can program these transactions even, because after all, the computer doesn't really care what does it say, right? As long as you can express it in some kind of digital format. So you can put ownership rights to pictures on there. You can put that's what these NFTs are. You can put ownership rights to properties on there. So you can do escrow accounts and what have you, contingent payments, lots and lots of possibilities that I believe we should seriously explore. Now, Bitcoin is very volatile in price. You have seen it going down recently due to some news what Elon Musk has done, and what the Chinese government has done is recovered a little bit. Now, if you think this was very volatile recently, you can actually look at the price paths in log scale, and you find that the recent volatility is perfectly normal for Bitcoin. But it has certainly gone up, right? And so who knows where it's going. All right. Well, so much for Bitcoin. You might ask, what determines the Bitcoin price if it fluctuates so much? And there are people like Warren Buffett would say that's just a bubble. Bitcoins are intrinsically worthless. I agree. Bitcoins are intrinsically worthless. I mean, it takes effort to create them, but then they're just piece of code essentially. But they can be useful for transactions, and ultimately that's probably what that should give them value if you think about it from a theory. And then it's no different from fiat currency. It's no different from a dollar-denominated note or a euro-denominated note. It's paper money that has no intrinsic value to itself either. If you go to the central bank and say, I want to exchange my 20 euro note, they just give you 2 10 euro notes. You just get paper money for paper money. That's the only guarantee you're getting there. So all of these currencies are bubbles in economic terms, which simply means that the price is larger than net present value of dividends. The net present value of dividends is 0. You could change that formula by saying that the transaction value maybe it's a dividend, and that's fine. And then maybe the price is equal to the net present value of dividend. But the problem with that is that if Bitcoin doubles in price, so does the transaction value, right? I mean, that's why a 20 euro note is worth twice as much as a 10 euro note, simply because you can buy twice as many goods for that. And so that's the starting point. And Linda Schilling and me investigated this in our paper, Some Simple Bitcoin Economics, where we use the model in analyzing what happens if you have two currencies coexisting and they're intrinsically worthless. And we show and then discuss and rediscover, we should really say, that we get as a result that Bitcoin price is a martingale. That means the expected future price is the current price. So it says that if you ask me for a prediction where the future price is here, I would just draw a line, and it's it sort of marches up and down here. So I think it's that's the best thing I can say with the Bitcoin price is going in the future. We have a follow-up paper on that where we also say some goods are easier to buy with Bitcoin, others with dollars, and then you can modify this result. But let me not go too deeply on that. Okay, now the crypto market is much larger than this, right? So this is the entire cryptocurrency marketplace, according to coin360.com. I got this picture a few days ago. I know that the Bitcoin is now trading at about $40,000, $41,000. And Bitcoin is by far the largest in terms of market capitalization, almost reached $1 trillion at some point. Now it's down to somewhere around $900,000. But there are other cryptocurrencies that are large. There's Ethereum here, there's Tether, there's Ripple, there's a Dogecoin, which actually started as a joke, but is now very valuable relative to when they started. There's a Binance coin. There are many, many more. If you look at this corner here, you're seeing that sort of eye powder in terms of smaller and smaller coins that actually build on the original, that are built on top of Ethereum. These coins have different concepts. For example, this one claims to be based on proof of stake and be energy friendly in contrast to Bitcoin. So there are all kinds of concepts here that you can look at, and it's just fascinating work. And we have to see how it shakes out. I mean, Bitcoin is often criticized for its energy uses and so forth, but there are lots of alternatives, lots of possibilities. If you want to create a better cryptocurrency, go ahead on the Ethereum chain. If you know a little bit of computer program, it probably doesn't take you longer than an afternoon. Okay, finally, big players are entering, right? I mean, this technology is attractive, you can do things with it, and so you're getting worldwide companies interested in this. And the first company that went out and really tried very hard to introduce their own digital currencies, Facebook. The original cryptocurrency was called Libra. It was meant to be issued by a Facebook-led consortium in 2020. It was meant to be permission blockchain digital currency, where there were only the consortium could register transactions on the blockchain essentially, and was backed by a basket of financial assets. And that would give it a stable value. It would be stable coin relative to this basket of assets. Now, this got fierce resistance by regulators, and I would consider that first attempt as being now dead. And so they revamped it, and it's now called Diem. Some say it's Libra 2.0. What they're doing now is they're going to move this from Switzerland to the United States to get the regulators on board. They're going to make this a dollar-backed stablecoin. There's some other changes that they did, and I think they just want to get the regulators signing off on a first version of this. And then who knows? Once that's there will be other entrants, and then maybe the original Libra will be good to go too. Now, mind you, there are already competitors to this, right? Tether is a US dollar stablecoin. It just isn't regulated like Libra does. So what you get with regulation, I suppose, is much broader appeal of something like Diem. And I'm mischievously also putting PayPal here, and that's really a payment system. But you probably for most people, you might not sort of see the difference as being very big between Diem and PayPal. PayPal, of course, is not a cryptocurrency. I realize that. I just throw that in here as an alternative. There will be more players to come for sure once Facebook succeeds. And you just see. I mean, the technology is simple, it's attractive. What can be done will be done. And looking at the possibility that the blockchain offers, where we haven't even scratched the surface, I actually applaud this development. And finally, we have to think about why regulators have been pushing back on this, why there was this fierce resistance. Well, that's a topic that I analyzed my paper with Pierre-Paul and Linda Schilling on cryptocurrencies, currency competition, and impossible trinity, where we focus on the minimum exchange rule of money, and where we look at two countries, let's say two currency areas, let's say Euro area in the United States, each with their own national currency. And now suppose you introduce a global currency, something like Libra, or suppose Bitcoin really became a widespread use, and lots of people would be starting using them for transactions. And in our paper, we assume it's a perfect substitute in either country to the local national currency. Well, then what happens if the national currency drops in value relative to the global currency? Then it will not be used. People just say, okay, I'm losing value if I keep the national currency in my pocket or on my computer, really, and then I can have this global currency. It's a better deal, right? And so this is something that now the central banks need to watch out for. And if they don't want their national currency to drop out, if they still want it to be used, what you then get is monetary policy synchronization. So this is related to the traditional impossible trinity result. It's a hardened version of that. And if the global currency is asset-backed, then you actually get a very narrow range for monetary policy. So if Facebook had succeeded with Libra, it would have put enormous pressure on monetary policy. It would have limited the range at what they can do eventually when Libra would be indeed a global currency. And you can see how central banks would be sweating on their foreheads and just thinking about this scenario. I think they probably treat Bitcoin a little bit as a toy currency. They can't maybe do too much about it, but once you have these big players entering and they're seeking regulatory approval, the game changes entirely. There's another aspect here. Once you have parallel digital currency circulating alongside the official currency, perhaps firms will price in that digital currency. I mean, maybe you wouldn't want to price in Bitcoin, that's very volatile. But once you have something more stable, why not? And if prices are sticky, now you have two sectors then that have sticky prices in different currencies. The central bank, you're operating one of the currencies, you're responsible for one of the currencies, and you have to then watch out for these fluctuations that come about because now these two currencies can move relative to each other. You get the martingale result that I talked about earlier, introduce a new source of macro uncertainty, and that's a challenge to the central bank, which we analyzed in that paper. It's a paper with Tao Yun-Hee at the University of Singapore. So the upshot is the large privately issued cryptocurrencies will be competition and headaches for central banks much more than the cryptocurrency markets right now. The market cap for so far is comparable to the market cap of cash in circulation in the United States. So it's already big, but presumably it could become much, much bigger. So that's why central banks now have started to introduce their own version or thinking about it. And these are the central bank digital currencies. Just last week, Jerome Powell, the chairman of the Federal Reserve, announced that soon there will be a study paper where they look at this world of digital currencies and cryptocurrencies. And he stated in particular, the focus will be on the possibility of issuing a US central bank digital currency. So the central bank will get in the act of that. Many countries are studying this. The Eurozone is studying this. Canada is studying this. And some countries have gone actually quite far ahead. So this is a picture that the BIS created in 2020 in August. So maybe developments a little further now. But you actually have two countries that already have a working central bank digital currency, and that's the Bahamas and the Eastern Caribbean central bank. So they're already doing it. You have China, which is very far along, and a lot can be said about China and why they're doing that, and how that might lead to concerns in the rest of the world that China has it and you don't have it. What might happen? Sweden is another country that's very far along on that road there. Certainly in Europe, you see discussion. Certainly in America's Canada. I mean, not in Mexico, apparently, but in Canada and the United States, you see this. So there are lots and lots of developments. So I think that you'll soon probably. My guess is that this year or latest next year, many of these central banks will put time plans on the table, telling us when the central bank digital currency is going to arrive for you. And if I had to make a guess here, it's gonna arrive pretty quickly, a few years probably at most. All right. Now, there are many, many issues once you introduce a central bank digital currencies that you have to worry about as a central bank. So if you hold a coin, a physical coin, it's a token, right? If I have a physical coin and I give it to Volker, then he has a coin, a token, and I no longer have it, but there's nobody keeping track of it. It also means that if I lose that token, that coin, it's lost, right? I mean, nobody can say, oh, no, here's a substitute for it, because we see you lost it. So the other alternative is to make this in form of accounts at the central bank, right? So central bank digital currency essentially have an account at the central bank. And if I were to transfer CBDC money from my account to Volker's account, I would essentially reduce the amount of my account, increase the amount of this account. But then it would be by name. And you can see that the problem there would be that in principle, the central bank could now follow all these transactions. I hear that the central banks are thinking about introducing, transactions that will be private up to a certain limit in order to get around some of these privacy concerns, but it's certainly an issue. Will it be hybrid or just a central bank? The central bank obviously doesn't want to offer, windows everywhere and dealing with retail customers. So presumably we issue a hybrid system where the front end to all that will be the banking sector, maybe the post office, and maybe Walmart. I mean, who knows, right? I mean, why not do this in Aldi and Walmart and so forth? It seems entirely feasible. But it doesn't alter the fact that ultimately these are accounts at the central bank. They will be coexistent with cash, presumably, so cash will still be there, but once central bank digital currency is there, then cash will surely be driven out. Now, mind you, all this has happened before. In 1900, the Banco de España essentially controlled 68% of all the financial assets and 75% of all checking accounts in Spain. So it's not like this is unheard of, but it obviously is in the world. Okay, now you might say, in that case, the households may no longer need retail bank deposit accounts. I mean, why? You can then do everything that you want to do with CBDC. You can make all the electronic payments and set up, maybe set up even regular payments and all that, if it's indeed programmable, maybe the way private cryptocurrencies are. And that could be good news, right? I mean, people talk about this as financial inclusion. You might actually finally reach people that are unbanked, that have difficulties making electronic transactions, and they can now do so by having CBDC. And you would argue there are no more bank runs. I mean, how can they be, right? Because you're transacting with the central bank ultimately. And how can there possibly be a bank run on the central bank? Well, let's talk about that actually. So the CBDC could promote a more resilient, efficient, inclusive, innovative payments, and that's just wonderful. But there's a flip side to this. There's a disintermediation threat. If you take away the deposit accounts, if you take away the safe funding base for retail banks, the stable funding base for retail banks, then the retail banks can no longer intermediate. They can no longer fund, mortgages, loans, and so forth, right? The very function that retail banks do. So when you if all that you do is have these accounts move over to the central bank, and the central bank doesn't do anything further, retail banking would be dead. Right? It would have to change in dramatic ways that are really good to contemplate and think through. So this can be avoided if the central bank then uses the funds to fund them back into the retail bank, so that the central bank could become sort of a flow-through position, if you like, for these funds and fund what the retail banks do. And that's a pass-through. And I guess I get Bruno Meyer-Niepelt here. Sorry for the abbreviation. Credit for showing that. Okay, but then couldn't conventional bank run concerns return? And indeed, the BIS in the paper said this could have financial stability implications that need to be assessed, both in terms of digital bank runs and longer-term consequences of bank running. So I looked at in two other papers, one with Jesus Financial and Daniel Sanchez initially myself, that got published in the Review of Economic Dynamics. Actually, not yet. It's in print. It's going to be published. And we show that if the central bank even wants to compete with private deposits, then the central bank must indirectly engage in the same intermediation. So that's the good news, that the central bank doesn't go swinging and offer things that private banks can do. Then central bank digital currency is not going to be as attractive. But then, if you do that, if the central bank does that, they're going to be more attractive than bank run because presumably they're more stable, and that could raise concerns that the central bank may become a monopolist and then drive out these private banks. So if you don't want to do this, right, then you have to think through this pass-through that my Niepel maybe announced. I mean, looked at that in this paper by Linda Schwing's lead author on Krisenfinanz and myself, and central bank digital currency when price and bank stability collide. And that exists as a draft. And here we're saying, well, this is all good and fine, but the central bank, after all, has several objectives. And if you look at the Maastricht Treaty, the key objective of the central bank is price stability. They should hold prices stable. And another objective is financial stability. It's also in the Maastricht Treaty, actually. It's subordinate to the price stability objective, but it's in there. And then finally, hope economic performance. So that's an efficiency goal, if you like. Now, so we analyze this in a version of a diamond diptych model. So that's for the academic audience out there. Again, that will be taking longer to talk about this. And of course, what happens? So then bank runs kind of return, but of course the central bank can always deliver on its nominal obligation. So that's not the issue, right? I mean, when you take $20 there, you get $20 back. I mean, that's it won't break that promise. But a central bank bank run can still happen, and they would manifest themselves now in that situation as spending money on available goods. So that's the version there. And what we get as a key result is a central bank digital currency trilemma that's here shown graphically and also put in words. Essentially, of these three central bank objectives, you can only achieve two, and you have to pick which two, and you're missing out on the third. There are ways to get around this, and the ways to get around this would have to do with making these bank accounts contingent instantaneously, as it were, on current financial conditions. You can do this with central bank digital currency, can't do that with cash. And again, that will be a completely new way how we think about money, and maybe that's where we end up going. Okay, so this is my final slide. Let me get back to my crystal ball here. Now we have seen the smoke come out and put words on this picture. The currency landscape is changing dramatically. Bitcoin has shown that privately issued cryptocurrencies are possible. It's maybe not the best technology. It's still the largest market cap, but the much better cryptocurrencies are already out there, depending on what you mean by much better in that sense. The technology is simple and attractive. It offers lots and lots of possibilities that are really, really interesting. Smart contracts, NFTs, and so forth. And the cryptocurrency market cap is already similar to currency in circulation. Bitcoin, big players, foreign countries are interested, they will introduce, and that means central banks are now facing competition in a way they haven't faced competition before. They will have to act. They are going to act. They're going to introduce central bank digital currency. And with that, you're getting all these privacy concerns. Probably these digital currencies will then distinguish themselves by the degree to which you can offer privacy and regulatory appeal and all that, right? So there will be a whole range of these things. But privacy is a concern not just to criminals. I mean, they value privacy. I certainly get that. But there are many reasons why perfectly honest citizens would value privacy too. So this is something that needs to be carefully watched when we design these digital currencies. It's really tricky. We can talk about that a little bit if you like. So private cryptocurrencies will continue to exist and flourish because I don't see that central banks will go as far as, say, Bitcoin or some of the even more protective currencies go out in terms of protecting privacy. So they're going to be there. And we're going to see how big they go depending on what the CBDC does. The technological possibilities are still at an infant stage. I mean, wouldn't it be wonderful to have an NFT app on your phone, right? If I had an NFT app on my phone, I could claim copyrights to this presentation, right? I could just say, give me encode copyright on the blockchain for this presentation. And if then somebody wants to buy it from me, they can do so. There was a recent article in the New York Times on NFTs, and was then the picture of that was put up as NFT, and somebody bought it for $560,000 US. So maybe I could actually make quite a bit of money by putting my little presentation here on the blockchain as well. anyways, it's a powerful technology, and it's useful, and it's useful in all kinds of ways. Blockchain is very useful even outside crypto, and there's going to be lots of developments as we go forward. These are all challenges to monetary policy, financial stability, and regulation. Of course, they are, but my take on this is: do not be afraid. These are exciting technologies and developments that will improve our lives. We'll sort this out. We're at the start of this all. This will revolutionize the way the monetary system will work in the future. And I, for one, am looking forward to that. So thanks.
Well, thank you very much. Excellent. Thank you, Harald, for these insights, and also for showing us, giving us insights on the work you have already done. Let me abuse my position as host to start with the first question and remind everyone else there are already a few questions in the tool. You can vote on them, you can add more. But let me briefly ask two things. Central banks are getting into this actually really quickly now, because we don't have a major private currency. I mean, Bitcoin, as you said, is not a serious competitor at this point, and it's by far the largest. So central banks are getting in this very quickly. And in addition, won't they be competing on this with other central banks? I mean, potentially one could grab a much larger market share around the world. If it's, for example, if they do cryptocurrencies, in the US, they could be used all over Africa much more easily than actual dollars, or over Asia or so. In the second brief question on the banks, I'm still somewhat hopeful. I mean, banks are supplying a key ingredient by giving loans and assessing the quality of borrowers, right? And so in giving the loans, so when I get a loan for certain purchases, I also get a deposit, because I get the money, I get a deposit, and then I spend it, sometimes not immediately. So there's this money creation process, and in the context of that, they have some power and influence, and they can tell us to keep, or that the money stays also in form of deposits. I'm just wondering how this private money creation then shows up in the models, or maybe it just doesn't play much of a role. But these two questions, and then I'll go through the next one and I'll read them if you want to quickly respond to those.
Yeah, let me quickly respond. I mean, so I fully agree, right? So I think the central banks are afraid partly of the big players out there. They're partly afraid of this cryptocurrency growing in market cap, right? It's no longer a small joke that's done by a few computer nerds. And they are afraid of the other central banks, right? I mean, China is very close to introducing its own central bank digital currency. And what prevents Europeans or US Americans from using the Chinese currency than for making transactions? I mean, who knows? Maybe China is even going to issue a US dollar-backed version of this, or euro-backed version, where they could, right? And then you could transact with that using that currency. And also that will lead to other countries in the Asian area to use maybe the Chinese currency. I could bet the Chinese are interested in this. Likewise, lots of countries like to use the US dollar, and if the US wants to keep its exorbitant privilege, right? I mean, they would probably do well to introduce a central bank digital currency to make that easier, right? And again, it's an advantage to them after all. So you're right about that competition. Now, the banks, you're right. I mean, they're doing important things on the asset side, screening borrowers. You don't want the central bank to do this. But on the liability side, I mean, you have to see where this goes, right? And it all depends on how advantageous these inside money, the deposits that the banks create are going to be relative to the CBDC. And I would argue that the competitive advantage shrinks, right? Before, you could just take out your money from your checking account, you would have cash. Cash is not quite as useful as a checking account. But CBDC, especially if it comes with all kinds of additions, like possibility to have smart contracts and so forth, it's going to be much more serious competitor. And it may go the way of the home phone, right? I mean, I still have a landline at home, but now if you ask younger people, what's your home phone number, they look at you, they don't know what you're talking about, right? They have a cell phone, and the companies in the home phone business are out of business. So banks better switch from the equivalent of the landlines to the cell phone business, and that's I think what we will be seeing.
Thank you. Let's start with the question at the top of my list here is Matthias Trabant, our new colleague here in Frankfurt. He asks, I go right to the question, cryptos require lots of energy, which appears problematic in light of the ongoing climate change. How should this be dealt with going forward? And the second question, cryptos seem to offer only a relatively slow speed in small volume of transactions relative to, say, credit cards. Will cryptos indeed replace other means of payment?
Yeah, no, this is an excellent question, and that's certainly true for Bitcoin, right? And but there are lots of other cryptocurrency currencies out there that actually very much try to address some of these failings of Bitcoin. They're just not as large as Bitcoin, right? This ADA coin that I mentioned before, that's issued by Cardano, claims to have solved these problems. In any case, I mean, there are thousands of cryptocurrencies, and it's technologically possible to solve this. It's just a question whether these cryptocurrencies then become popular. It's true that Bitcoin at this point uses up the energy consumption of a country like Argentina, somewhere around 0.5% of world energy consumption. So that's certainly not trivial. You could, even for Bitcoin, reduce that drastically by just having the Bitcoin miners agree on reducing the number of Bitcoins a miner gets. So that would be one way of doing it. If the Bitcoin community could get together, and I here want to talk to the Bitcoin community, I hope they take this proposal seriously. It would take away some of that criticism. If miners no longer get 6.25 Bitcoin, but they're getting 0.1 Bitcoin, then the energy consumption would go down by that ratio as well, holding the Bitcoin price stable. So, and that's just because the miners do all this energy consumption in order to get these Bitcoin prices that are issued every 10 minutes. Now, mind you, you don't want to do this instantaneously. I understand that the miners have invested in equipment, right? But you could plan this for, I don't know, 3 years from now, when the current mining machines are out of date anyways. And that would solve the energy problem. It raises another problem, and that's something that Budish and Leshner have pointed out and others, because you want to keep transactions on the Bitcoin blockchain secure, and that requires that attacking the Bitcoin blockchain should require lots of money. And so there, the energy consumption actually helps. So it makes the Bitcoin chain safer, but of course, you have the environmental concerns there too. I think ultimately the solution here will be, this will shake itself out. Bitcoin could probably do these changes and become a niche player eventually, and then some of these other cryptocurrencies out there could emerge having solved the energy problem, the stability of the currency problem, and so forth. I mean, Libra certainly wouldn't have that energy problem, for example.
Maybe a related question before we move to a different topic by Rolf Buxenschütz on the impact of CO2 prices on cryptocurrencies because of energy need for mining. I don't know if you want to add something related to that.
Yeah, I mean, it's so what these miners do is, in order to mine as cheaply as possible, my understanding is that they're often using surplus energy. So they may actually, in an indirect way, help the environment. I mean, if you think about wind energy has a problem that the wind blows hard sometimes and doesn't blow hard other times. So energy companies always have the problem that they have to have additional, they have to have energy at disposal in case wind energy dies or solar energy dies, right? And that's done with coal, that's done with nuclear and so forth. We can try to store energy, but so far we haven't been successful to store massive amounts. So having all these other energy producing and for coal, less environmentally friendly plants. Now, but with Bitcoin mining, right, the Bitcoin miners might actually take away peak wind energy. They might actually be keen on consuming peak wind energy, because then presumably wind energy would be sold cheaply. And then that's a time when a miner would, turn on this machine and mine, right? And so it helps, consuming the peak energy. The miners don't mind when that happens. And then the rest of the wind energy could lead to a smoother supply of energy. So I don't think people have thought that through entirely, but there's even a sense that possibly the Bitcoin energy consumption could help rather than worsen our CO2 problems.
As a provocative question by Balin Tatar, he asks or speculates, many individuals invest into Bitcoin and other cryptocurrencies as they fear that due to QE and limitless money printing, national currencies will suffer a huge loss in value in the future. Would the normalization of multi-policy and the termination of limitless money printing not end the cryptocurrency madness and let finally the bubble burst?
Well, I mean, my paper that I briefly touched upon with Linda Schilling in the Journal of Monetary Economics, we just get that the best predictor for future Bitcoin price is essentially the current price, modulo some risk adjustment that you can throw in there if you look at the formula closely. And so, again, it's a bubble, but it's a bubble that potentially is justified. And I say potentially because we don't see many transactions. It's potentially justified by the fact that Bitcoin can be used for transactions. And so, Bitcoin gets more widespread as a use as a medium of payment, right? Then actually the price could go up rather than down, regardless of what monetary policy does, whether it returns or doesn't return in terms of quantitative easing. It's probably true, I concede that many people may have bought Bitcoin, seeing the vast price rise over the last 10 years and saying, oh, I want to get in on that. I want to get some action. And, that's fine. I mean, people do that, that's their own money. They may end up being disappointed. That's entirely possible. It's again, based on my own academic research, and, that's the best thing that I can say at this point. The Bitcoin price in the future may go up, may go down, on average, it will stay the same.
So a question from Guido Maya, how would the central bank digital currencies use blockchain technology in terms of operations? What would be the similarities and differences from the way a cryptocurrency as Bitcoin operates today?
Yeah, I very much doubt that central bank digital currencies would use a blockchain. The blockchain is I mean, essentially it's a the data storage, right? It's I'll share this. No, I'm missing the right word, right? But you're just storing data. It's just a way of storing data, and you can store data on your computer. You can store this in a file. The central bank will presumably store all these transactions on their computers, right? They don't need some blockchain out there. Blockchains are good when you want to use a database. Databases would when you want the database distributed and used by many parties simultaneously. And lots of people out there that add to that database and subtract from that database. Then blockchains are great, and there are many uses for that outside the crypto world. But if all the accounts run via the central bank, no reason to have a blockchain. It's slightly different. So we have to see how this works with the hybrid system. If you have front-end companies doing the CBDC and maybe even keeping track of the CBDC transaction, that's a possibility. It's possible that Aldi does it, that Deutsche Bank does it, that there are many players involved. And then you could get to something like a permission blockchain, almost in the way Libra imagined it. I suppose that's a possibility. I don't think that central banks go there, but I haven't seen the detailed plans by central banks on that.
So in terms of next questions here, Anna Agresti, any views on the role of the NFTs and how they differ from crypto assets? Do you think that the market of NFTs will further develop and will need to be regulated?
Yeah, I mean, maybe, an NFT is a crypto asset of sorts, right? I mean, okay. So it's true that there are some people, so why did that, I think it was Extreme Music or something, I forgot the exact acronym, that bought that New York Times article for $560,000. Why on earth did they do this? Why would somebody buy a picture of a New York Times that he could just do by a screenshot and pay $560,000 for it, getting that copyright to that particular picture? That's really what happened. And little is known about them, about that group, but they said they're in favor of that market. They want to advertise that market, and it's great advertisement, right? If you think about it, right? They advertise NFTs. Now many more people have gotten interested and they say, holy cow, there's something going on there. And if they're in that business and they're making money from that, maybe $560,000 was pennies at the end. So having ownership rights and transferring ownership rights is a tricky thing. Normally, notaries and all of that, right? If you do this in the blockchain, it's much easier. And ultimately, this is where I see NFTs and digital assets will go. Now, where precisely it is useful and where it is not, I mean, that may be harder to say. But should it be regulated? I mean, these people knew what they were doing. I mean, they're part of this $560,000 of their own money. Should I tell them not to? I mean, what do I know about their motives, and what gives me the right as a regulator to tell them you can't do that, right? And so, I mean, some people lose their money, lose their shirt. As always, if you spend your own money, right, be careful, right? I mean, don't call on the government always to bail you out.
Let me collect a few questions here, several questions which also touch on monetary policy and the money supply. So Karl-Heinz Tötter says, you said that the CBDC, the central bank digital currency, are a response to the competition of the private sector. He asks, isn't it the other way around? I assume he means private sector digital currency are a response of private investors who increasingly lose trust in central bank money because of ultra expansionary policies. So related to Balint Tatar's question, and Michael Haliasos asks that, well, if there is a fear of disintermediation due to central bank digital currencies, would it be a good idea for central banks to hold deposits at commercial banks and conduct monetary policy by varying those?
Yeah, so let me start with the latter question. I mean, that's sort of exactly what we try to do in this last paper that I briefly touched upon, that effectively you have to have this pass-through. And the way to think about this pass-through is, if the central bank receives lots of resources due to selling CBDC, CBDC becomes much larger than cash, essentially. They should funnel these resources back into the banking system, essentially hold deposits there, if you like, and let the private banks then do the intermediation, the loan screening, and so forth. So, but it's something that we should think hard about, and the central bank should think hard about as they introduce the CBDC. Now, whether the crypto market is particularly popular because of all the monetary easing and so forth, I mean, it's possible. It's possible. I mean, certainly, quite a number of assets have gone up in value as normal interest rates have gone very low. But these developments have been taking place since 2008. Okay, 2008 we had another financial crisis, of course, but I very much perceive them as developments that are driven by the technological fascinations with the possibilities. I mean, the things they can do on a blockchain are really amazing. Ethereum, for example, offers a Turing-complete programming language, right? So if you have a program that computes a solution to a dynamic programming problem, and whenever you spend a coin, right, it's going to do that. You can do that on the Ethereum blockchain, and that's pretty crazy. Now, of course, you have to pay somebody. You have to pay Ethereum coin in order to do this. You have to pay gas in order that these calculations are executed. But we haven't, it's sort of like when the iPad came out, right? I didn't know what to do with that. Now almost everybody owns it, and there are lots of apps for that. And so there are all these technological possibilities, but they're not yet at our fingertips, right? I don't have an Ethereum app on my iPhone that could use a range of these possibilities, a Bitcoin app that could use a range of these opportunities. And so maybe what we are seeing in these increasing market capitalizations for the cryptocurrency markets is a discovery of investors that, yes, there are many possibilities out there, and this is a little bit like the dot-com boom, and it's going to shake itself out, and some will die and some will flourish and become big players.
Let me take together two more questions. One by Volker Neuhoff, who says, how can you control the money supply if foreign private currencies are allowed in parallel? Why is there no more interest in controlling the money supply? And related, Francis Gross, who says, how will monetary policy work if people move to cryptocurrencies detached from national bases in their central banks? Who would care about central bank rates if their currencies lose tractions? Can governments accept that, even in theory?
Yeah, so I mean, this is sort of what I analyze in particular in my paper with Pierre Benigni and Linda Schilling. It's Fellows-Town on Keys. So if those that download the slides, go back to that. It's true. I don't think that central banks will want their own currency to disappear from the landscape. And so they will have to compete with whatever digital currency might be used in parallel. If it's just Bitcoin, they can say, oh, well, it's not used that much. the transaction volume there is restricted and so forth. But I mean, this could become big, right? And I think that's why they were afraid, frankly, of Libra. Now, if there's a large or several large digital currencies in circulation and people use them for transaction pricing, then there are challenges that arise. For example, my paper with Linda Schilling that appeared in the Journal of Monetary Economics, we have shown the following, that if a central bank wants to keep the, let's say, the dollar price level constant, and the Bitcoin price goes up in value, which can happen, right? And we've seen these vast fluctuations in Bitcoin, and Bitcoin is the currency that's used. So let's say the digital currency that's used is fluctuating a lot still. Well, then you have to keep the total quantity of money the same, but the Bitcoin money has now gone up in value. The only way you can do that is by taking money out of the system. So the central bank essentially has to take out money from the system. It is as if the central bank is paying for the price increases of Bitcoin. And it's as if the central bank is ultimately paying. So these are issues that you know, these interplays between monetary policy, prominent digital currencies in parallel, are things that need careful attention, and I've tried to touch upon them in my papers. I mean, these are intriguing, deep questions that, you know, I could talk about for hours, but I don't have the time.
Two more questions. One is, Jochen Möber, do you think a martingale is really a good description for Bitcoin? Given your definitions, gold prices follow also a martingale, but on average, gold prices rise for decades or even 5,000 years. And Mark Wallenburg says, given that central banks and private corporations compete in this field of digital currencies, is it okay to give central banks all regulatory power to block new entrants? Is this an example of den Bock zum Gärtner machen, set the cat among the pigeons? So should we, you know, I mean, not every central bank has regulatory power, but there's a question about the split of regulatory and central banking powers.
Yeah. So with gold, you know, I mean, gold is different from Bitcoin, at least in my view, right? I mean, it can go, I think gold in the truth, there are lots of uses for gold. I mean, people like things in gold, right? I mean, you know, if I could, you know, maybe if I could buy this cup here made out of gold for a few euros, I mean, I would, right? It's pretty, right? And you can't do that with Bitcoin, right? You can't create, you can't create this from Bitcoin. So there's that difference between gold and Bitcoin. I'm actually with Prof. and Linda Schilling, we're actually working on a paper where we try to get at the difference between gold and currency, and it's trickier than meets the eye, but this is sort of a super short summary. So it's a good question. I don't want to, I don't want to be too dismissive on this. It's something that we're working hard on, thinking hard about. But again, gold has an intrinsic value. Bitcoin does not, and I think that's a key difference. The martingale result, or risk-adjusted martingale result, and again, it's an older result that we rediscovered, I would say, in that context. You know, is that a good description? Well, give me a better model, right? If somebody can convince me that there's a better model, I'm willing to see it. You could probably argue that right now, before Bitcoin, let's say, is used widely as transaction, if we assume that paper, that maybe investors demand interest on holding Bitcoin while it's not used in parallel with US dollars. And so there could be an extension of that analysis allowing for that. There are researchers, Czerwinski and others, who have looked at the risk premium that should emerge for Bitcoin prices. And it turns out that the Bitcoin fluctuations are pretty much uncorrelated with other fluctuations out of the stock markets, macroeconomic risk, other known factors that influence, say, stock prices. And that should really mean that there shouldn't be risk premium on these Bitcoin fluctuations. So, I mean, I grant you that the rise in Bitcoin has been phenomenal and has been large. A year ago, I would have said, well, maybe there's an anthropic principle here because we only look at Bitcoin because it's risen so much. But it keeps on rising, and it's now, you know, much higher than it was when I started this research. And why, I wish I had a good explanation for that, and I do not.
Okay, and we're not asking about how invested or not invested you are in Bitcoin. But anyway, we still have a lot of questions. We are basically, in principle, out of time. We have 1 hour, but I think we still have 140 people listening. And so maybe we can take another 5, 6, 7 minutes to answer some of these questions, if it's okay with you.
That's sure, that's fine with me.
Okay, so we're going to go over a little bit. We might not cover all the questions, but a few more. Leonard Salzman asks, suppose we live, a very concrete question, suppose we live in a world of multiple cryptocurrencies and one conventional currency is issued by the central bank. In this situation, would you anticipate a smaller or a larger impact of interest rate rises on inflation and real activity?
Yeah, so that's a good question. It sort of depends on how the exchange rate reacts to these interest rate changes, right? And if it's again, the martingale result, that the future price changes are unpredictable, include the possibility that the unpredictable change is correlated with unpredictable changes in monetary policy. And so from there, you can get larger impacts, right? And suppose whenever the central bank surprisingly raises the nominal interest rate by a little bit, the Bitcoin price goes up by a lot, right? So the martingale formulation would allow for that. Then you could potentially have much larger impact. But my guess is you would probably get a smaller impact because now you would have this dollar world where people trade in dollar and use dollar and price in dollar. And the central bank would have an impact there, but would have a lesser impact on the rest of the economy or the other digital currencies used. It also depends on how the other currency is designed, right? If it's a stable coin, stable in terms of the official currency, then of course you're effectively back to one dollar being used for all the transactions, for all the pricing. So we have to see which are the global currencies, or which are the digital currencies that come out as winners, and how stable are they relative to the national currency in use.
Sazan Mansouri asks, how would the US central bank coin comply with US sanctions on countries like Russia, Iran, etc.? So what if your currency is used elsewhere? I guess the same problem applies to physical currency, right? Which the dollar circulates in Russia or circulated. So I guess the answer is, but anyway, what's the answer?
Well, I think there's a difference then between physical currency and digital currency, right? With physical currency, it's super hard to avoid that illicit transactions or transactions between parties that you don't like are made with physical currency, right? If some weapons traders get their hand on a suitcase of US dollars, what do you do, right? You could go into that transaction physically and try to do something about it. But with central bank digital currency, if this all tracked on the central bank's accounts, and you have intelligence of who's doing the transactions, potentially could go in there and say, no, you can't make that transaction. Now, we'll have to see whether that ultimately is good for the US or not, right? You can turn off certain transactions that you don't like. I suppose that's a good thing, but you may also end up turning off lots of transactions that where people are afraid that that ultimately they might no longer have access to the CBDC accounts of the United States. Changes policy views or whatever, right? And that would actually drive people away from the crypto dollar to private cryptocurrencies, I would imagine.
Here is a more basic question. Frau Körn asks if bank accounts are also not backed by physical coins. How do current account balances, how can they be distinguished from real digital currencies? Is the only difference that customers have their account directly at central banks? Or where do we draw the line? Or is it the DLT blockchain technology that defines a digital currency?
So there's a question about checking accounts currently.
How do you see maybe the competition between checking accounts and which are digital or other digital means? You mentioned PayPal, right? We could expand the question from true digital currency.
Right. Currently, your checking account ought to be backed by physical assets that the bank holds, right? By investment in loans and mortgages and so forth. And they may be long-term, and that usually gives rise to these bank-run concerns that a lot of people want to withdraw, their deposits on short-term notice, and the bank may have to liquidate its long-term positions at a cost unless there's a lender of last resort stepping forward and solving that problem and giving a loan to that particular bank. So there's a there's value on the other side for a traditional bank. For Bitcoin, there's no value on the other side, right? For Bitcoin, there's no value on the other side. I would argue that even for a central bank currency, there's no value on the other side, even though the central bank balance sheet has value on the other side, but you're not entitled to that value, right? You can't go to the central bank and say, hey, I see those bonds on the asset side. Here's my currency. I want your bonds, right? You can try to buy them on the market, but if the central bank doesn't want them to sell them to you, they don't sell them to you, period, right? That's different from a private bank that has to fork over essentially central bank money of some sorts if you go there and withdraw. So these are all these differences, and as a result, currently checking deposits are much more regulated, much more tied in, much more confined, if you like, by these bank solvency requirements and Basel and so forth than cryptocurrencies are. Because with cryptocurrencies, you can create inside money without having to worry about reserve backing, without other assets and circulating and they're alive and well. There are some exceptions to that. If you think about stable coins, for example, I guess the stable coins really only work if they are backed by assets. I'm not a believer in algorithmic stable coins. And so Tether, for example, needs to maintain balances in US dollar denominated assets in order to maintain the exchange rate.
So maybe two more questions on the central banking side. Alina Tenzer asks, how would you rate the scope of central bank policy measures when it comes to cryptocurrencies? Would there be novel policy tools required? And Francesco Papadia asks, what can we learn from the discussions about Fisher's Chicago plans with regard to central bank digital, or in terms of addressing central bank digital currency issues?
Yeah, so I mean, the first question I would maybe answer in the following way, that central bank digital currency offer central banks lots of new tools that I think are fascinating and that I would encourage central banks to think about, right? Do you want to allow for smart contracts? Do you want to allow for NFTs and all these kinds of things? I mean, why not, right? And how are you going to make maybe use of blockchain technology? I think that's where it would maybe come in order for that to happen. But this, you don't want to issue something that's already technologically out of date when the private issuer is issuing something that's much fancier, much better, right? And so I think central banks better include some of these features. It also offers new policy tools, right? You can have negative nominal interest rates on central bank digital currency, and that can help, right? In the last decade, central banks were pretty much stuck at a zero lower bound. I mean, they couldn't go far negative, a little bit maybe. But with central bank digital currency, you can. Now, this sounds like I'm endorsing the central bank taking money away, but it's ultimately the real return that you get on it, and the nominal return, you don't care that much. And it would offer the central bank the opportunity to stimulate the economy again if they otherwise would have landed at zero lower bound. You can make the central bank digital currency accounts contingent on current events. And that would be a way of resolving this impossible trinity, that I documented in my other paper with Crisis Finanzwert and Wilmer Schilling. That would be an entirely new way of thinking about currency. So the sum of this all is that central bank digital currency offers central banks lots of new tools and lots of new possibilities that ought to be explored. And I think they're exciting and they shouldn't be cast away from the get-go. The second question, can you remind me what the second question was?
Sorry, now I put it away.
That's fine. Let me call it.
I'll be back. There was the Alina Tenzer, the measures. You've responded to that. And Francesco Papadia, what can we learn about the discussion or from the discussions about Fisher's Chicago plan?
Right. Yeah. So the Chicago. Right. Chicago. Exactly. Here. So so the Chicago plan was essentially saying, well, let's just avoid bank runs by having banks only hold very liquid assets, treasuries and that sort of thing. It's sort of very similar in spirit to the Vollgeld initiative that came to vote in Switzerland, and the Swiss rejected it. And I think they rejected it ultimately for good reasons, because the maturity transformation that the banking sector does aids efficiency. I think that's what we learned from the diamond dipping world. You can make, this is again this this result that I had in this paper that I presented on the CBDC trilemma. I mean, you can make the banking system safe by doing essentially versions of the Chicago plan, even at the central bank. But then you're losing all the possibility of handing out loans, what the banking system traditionally does. At least you would have to think hard about how to restructure that system. I mean, there may be ways of doing this, where these are different funds and different types of contracts. I mean, I can see that potentially happening, but you would no longer have that link between, means of payments and maturity transformation. So delinking it, I mean, it's possible, but it would completely change the financial landscape, and research should be done thinking that through carefully. So our paper was a step forward in that direction.
Okay, I think we're basically out of time. We can, if you want, respond to two last questions. So we won't answer all of them, but maybe there was a question on by Mevaltes Falassi on, would a private cryptocurrency dominated system tend to raise the frequency of deflationary episodes when you have these private currencies competing? And there is another question maybe we could ask by Jean-Paul Lam. He really talks about proof of work and proof of stake. Proof of work having the problem of massive investment in computing power and energy consumption, and proof of stake problems since you need to choose the miner carefully, otherwise you will reward only large players. So maybe the technology has not really arrived yet for the future private currency. Yeah, so that's to the crystal ball.
Yeah, no, great question. So thanks for all these questions. They're thought-provoking, and they really go often deep in the topic. So I don't want to dismiss them and just give you sort of a quick take on these. On the inflation issue, well, it depends. I mean, suppose we only have a single privately issued digital currency, and central bank was out of the picture. They've missed about, and it's one digital currency surviving, and that's our monetary system now. Will there be more deflation? Well, that depends very much on how that digital currency is designed, right? So if you think of avoiding deflation by having faster money growth, I mean, that will be sort of a simple quantity theory type logic. You could certainly design the inflow of new coins by making that, by accelerating that, right? If there's deflationary fear. Now, you're certainly right that for Bitcoin, for example, there's a limit of how many Bitcoins eventually get issued, right? So the Bitcoin supply is eventually going to be stable. And if you have a stable money supply and a growing economy, there has to be deflation, in my view. So that's another reason why I don't think that Bitcoin will take over the world. But you can design other currencies where there's introduction of new coins. I mean, there's a reason why Bitcoin made this way, and why you might want to, be careful with saying, oh, we're going to introduce more coins in the future, and we could go into this. But in principle, from a computer science perspective, it's no problem to design the inflow of currency in such a way that you would get, maybe fairly stable inflation. As a matter of fact, pretty much doing what central banks do these days. On the question of proof of work and proof of stake, yeah, I mean, these are, as we speak, right, there are lots of people writing computer science papers and economics papers. It's an interesting intersection, right? So all of you out there that do, research in game theory and have an interest in computer science, team up with a computer scientist who has an interest in game theory, because it's really at that intersection of these two sciences that we have to talk about. You can't solve it from a computer science perspective alone. And maybe you can solve it alone from an economics perspective. I mean, that's a bias I have as an economist, but it's probably good to take computer scientists on board. And there are people thinking about these things. If you design, I agree, proof of stake also has its issues, right? And then you can modify it. You can avoid that there's a single large player taking it all over. You can have, permissions, right? I mean, that's certainly how Libra was designed. And so, so it's true. There's research going on. And that's also why, lots of research and lots of people thinking, and how do you make it safe, and how do you make sure the chains can't be attacked, and what certain circumstances can they be attacked. But the same is true for regular bank transactions, right, that need prime number-based algorithms that there's still currently a lot of research on, and so forth. I mean, once you look under the hood of how payment system works. There's a lot of intriguing technology and computer science and math and economics on it that we usually don't think about. And so I'm confident that the computer science and the economists will sort that out and come up with ways of designing cryptocurrencies that will be reasonably safe and reasonably appealing and do work in all kinds of ways. And actually, as a matter of fact, those currencies might already be out there. Right? That would be too much of a tall order for me to say this one does it, but I wouldn't be surprised at all. The big cryptocurrency of the future has already been invented and has all the great features that you'd want.
Well, thank you very much. I just saw there's one question was at the top. I didn't see that. Maybe we can quickly check that. Kika Gerke, it is true that retail client accounts at central banks are not unheard of. The most extreme example was the Reichsbank in the 1930s. 100% of accounts were there. Not sure that this is a good model. Do you have a remark on that? And then we close.
Yeah, no, thanks for that. I mean, that's another, I don't know that example that well, but I trust that information. So yeah, so that's a good point. It certainly has been done. Certainly done in the Spanish case, right? And so, the Postbank in some ways is a government-run bank. It's not quite a central bank, but it's lots of branches. So it's not, it's not impossible, right? Maybe the central bank could join with a post office, and then they suddenly have lots of branches to do this. So we'll see where that goes. I mean, I think at current central banks want to avoid it, but maybe that's where we end up.
Yeah, that reminds me when I was traveling around a long time ago with Interrail and my Post Sparbuch, and all over Europe, at any post office, you could get some money. Exactly. So of course that's before much other technology, but it's true that was certainly government-related account and accepted everywhere.
Right, exactly.
Anyway, let's close here. Thank you to everyone for your interest. A lot of people stayed around. We're way over time, but it shows, Harald, you've answered many questions, you've raised many new questions, and thank you for having you here. To everyone, let me just remind you, the slides will be posted on our website. Maybe they're there already. There will also, if you want to advertise this fascinating talk, there will be a recording and you can point it out to others. We actually have an IMFS YouTube channel, and there are other talks. And we will actually, I think in 2 weeks, have a talk by John Campbell from Harvard on, let me just check, the topic will be portfolio choice with sustainable spending, a model of reaching for yield. A somewhat different topic, but it will also be addressed at a broad audience. So hope to see you again in this virtual room, and goodbye, good night for many of you, or good evening for many of you for today. Thank you. And thank you very much, Harald.
Thank you for giving me the opportunity, Volker, and thanks for all the wonderful questions. Thank you for listening.
Great.